we looked at the overall trends, and we thought that the calls that were essentially a bearish pitch book were just not accurate. They were based on near-term trading. When we saw what the situation was in terms of the corporate resilience, the consumer's stance, and where the Fed was being effectively very much sensitive to applying its mandate to inflation that was at untoward levels, we couldn't help but think we'd rather stay in the market rather than try to time the market, recognizing that time in the market historically has shown to be a good way to get better returns over the intermediate to longer term.
So the Bloomberg reporting of your call here this morning, John, Oppenheimer, asset management lists S&P 500 target to Wall Street high of 5,500. What's driving that? Is that earnings driven? Is that Fed?
It's a mix of both. It certainly is earnings driven. If you consider third quarter and fourth quarter S&P 500 earnings really surprised very nicely to the upside. In addition, if you look at GDP and you reflect on Fed policy, the Fed has been remarkable with 11 hikes and 6 pauses or skips, as they call them, now has not pushed the economy into a recession. And then beyond that, the fact that what we believe is, and it's interesting, you just had George Ball on, and you all spoke about investors and retirement and things like that at one point. It's today 2 generations and more than that, the younger ones that follow the millennials, but the millennials and the boomers recognize the fact that Social Security is likely not to be what it once was as a core to retirement for prior generations over the decades. And in addition to that, the recognition that they will likely live longer. And so whether preparing for retirement or in retirement, there's a need for equities. Equities historically, again, with past performance, no guarantee of future results, as we always say. But equities tend to be a better place for intermediate to long-term investing and diversification.
Okay.
Paul's, in our view.
Paul's living this. John, you and I have to work every day. Sweeney could have retired 14 years ago. But the bottom line here, Paul Sweeney, is when was the last time bonds made a return?
Yeah.
And I'm talking, you're back 5 years, 7 years or whatever.
John, it's interesting. It's, Tom was just mentioning, you think about the fixed income space, just got crushed in 2022. And thanks to a miraculous November, December, they eked out some gains last year. But in the equity markets, I guess the question for a lot of folks is, where do I go here? Do I follow the Magnificent 7 or 5 or whatever they are today? Or do I try to find some value in other parts of the market? Where are you at this part of the stage?
Great question, Paul. We think you have to mix and match, which really means diversification. And by that we mean we emphasize cyclicals over defensives, but still want some defensive in there for higher yielding dividends. Growthier value for companies that grow their dividends, and still want growth because the innovation points to the very clear fact that much more sophisticated technology that we have today versus where we were when the tech bubble happened. And being 40 years in this business, I can well remember the tech bubble, which is not that long ago. This is an environment where technology keeps morphing, and it can very well help all the sectors, including both itself, technology and communication services, which is over 50%, about 60, 70% technology, but all the others help companies become more efficient, help consumers be more efficient in approaching their relationship business as well as each other.